whether it's small scale or large scale, like common sense really matters in this space.
I think that the state of Bitcoin custody is very good, very interesting. A lot of great companies, great products, great options.
A lot of what Bitcoin does is it exports property rights globally, and it gives anybody that can hold a private key and hold their own Bitcoin, you now have the best property rights that have ever been invented.
The new technology does what the old technology does, but it does it in a much better way.
Let's introduce Ryan, Andrew, Ian, and Sam. A huge round of applause.
All right. We got the last panel before lunch, so we got their full attention, I'm sure. Thank you, Bitcoin Park team, for having us. Excited to be here to talk about Allocator due diligence. I'll kick things off with some intros down the line. So I'm Ryan Gentry, formerly of Lightning Labs, now running Bitcoin Infrastructure Acquisition Corp. And excited to have these great gentlemen up here with me today. Andrew, you want to go ahead and introduce yourself?
Andrew Hohns, I'm the CEO of Battery Finance and New Market Capital. Delighted to be here with all of you today.
Hi, guys. I'm Sam Abbassi, founder and CEO of Hoseki. We do digital asset underwriting and custodial risk in our CRM and API platform.
My name's Ian Northon. I'm a co-founder and chief legal officer of Ocean, which is a Bitcoin-only mining pool. And my background isn't really due diligence, but it was litigation, primarily federal trial court work, pension fraud, ERISA, and other types of disputes that arise out of bad due diligence. So I hopefully can bring some perspective to it.
Awesome. So here at the Custody and Treasury Summit, where we're talking about allocator due diligence, I think in particular, we're talking about as allocators or as custodians, what are allocators looking for from their custodians? And I know the core tenet of Bitcoin, of course, is not your keys, not your coins. But as you get into the more kind of professional financial world, sometimes you have to trust somebody else. So I think, Andrew, just kind of start with you. From your perspective as an allocator, what is the state of Bitcoin custody today?
I think that the state of Bitcoin custody is very good, very interesting. A lot of great companies, great products, great options. I think that for most institutional allocators, it's just lost on them. I was in a meeting over the course of the last week with the product lead at iBit. And, to me, it seems more and more clear that those that are thinking about an allocation to Bitcoin today are just happy to say, BlackRock has it. I don't really need to go further than that. And they're not getting into the details. And as a result, they're not aware of all of these distinctions.
I love that you started there because I was having a conversation yesterday. I don't think he's in the room, but with Cam at OnRamp, and he was making the comparison where he's like, Bitcoin custody today is a lot like Web 1.0, like the earliest days of websites, where you would have, Time magazine, and their website was just their magazine, right, on the web, instead of the physical print, where they're not really taking advantage of the native capabilities yet. They're just happy to be doing internet, right? And so I think, Sam and Ian, I'll turn it over to you a little bit. Like, what are, as kind of, I would say, more kind of Bitcoin native operators on this side, what are some of the things that you think are, native capabilities that are not being taken advantage of that are special about Bitcoin that can help improve custodianship over the kind of legacy models?
Yeah, I mean, proof of reserves as a function of auditability, I still think is something that's underutilized and undervalued in the space. Just piggybacking off what Andrew said regarding custody, I think sort of the asymmetric nature of custody in this space is something that, and just from the retail side, most banks and most institutions still haven't really gotten over the learning curve necessarily, because it's so antithetical to how traditional assets function. I mean, the idea that I have an asset that is liquid, that I genuinely have in my possession is so unique. And so for them, they're still getting comfortable with that concept just to begin with. But in terms of native properties that Bitcoin embodies, the thing I usually say is that no one knows exactly how many US dollars exist in the world, nor how much gold exists. With Bitcoin, any third party can see exactly how much of that monetary unit is in existence down to the smallest unit, and that is really novel. And so that's at the macro scale, but down to the individual or the institution. And if you hold your own keys, at the level of the network are an institution, that auditability still, I think, is critical.
I would just add that, for as new as Bitcoin is, and everyone in the room is early, we can hear that, these concepts aren't new, right? You're kind of putting old wine in new wineskins. I mean, it's a situation where if you want to prevent an embezzlement with a small business or a large business, you have controls in place. You can do that with Bitcoin. If you want to prevent counterparty risk. You kick the tires, take it for a test drive. This is something like know who you're dealing with. I mean, I think a lot of times because of the digital nature, people say, oh, I can review the data, or we put all the data in the data room, or we've done our due diligence, but you take kind of a false sense of comfort with that because you've reviewed a spreadsheet. But have you done the traditional things like look somebody in the eye and know, did you run a test transaction before you sent the big one? Just whether it's small scale or large scale, like common sense really matters in this space, especially when people, oh, it's new, and you get caught up in the moment. And I think you have to remind yourself to slow down, and you're not reinventing the wheel when you're dealing with trust or trustless technologies. You just have to understand that there is more risk because it is a bearer asset, and you have to be mindful of that. And most of this allocation or people allocating to a treasury company or to a custodian or to a new company that says they're going to be a Bitcoin company, are they? Have you talked to the people? But you can kind of get back to basics and remind yourself, what's your role? Are you the fly in the ointment that's going to double check everything? Are you the big picture guy that's going to say, what's my role here? Am I a fiduciary? Am I holding someone else's money? Is it my own? Just get back to basics. And if you start from that perspective, then there's usually experts in the space that you can rely upon, or just remind yourself of kind of tried and true principles so that you don't make the same mistakes that inevitably everybody makes, right? So you just want to avoid those big losses when you're trying to do, kind of classic digging into the weeds and looking under the covers to see what's really going on.
Yeah, I guess that I would add that the programmability of Bitcoin is not understood right now. And it's really pretty different than any other asset that an institutional investor is accustomed to holding. I mean, you can't program your gold, you can't program your publicly traded shares or your private equity holdings. And as a result of that newness of that feature and other features as well, right? Like the programmability allows for time locks. We spent a panel ago talking about, or 2 panels ago, the ability to decompose the signatures and even shift the signatures dynamically over time. And that could be extremely useful for an institutional investor if they embraced that kind of feature set, but it's a completely new feature set, and it comes with a totally new vocabulary, and the gatekeepers that are relied upon in that universe are also not really familiar with it. And the idea of becoming a gatekeeper, it's not that easy, because if you look and if you look at like the request for proposal in Pensions and Investments magazine, where somebody will say, we're looking for a new operational due diligence consultant, it says typically minimum qualification that you serve in this capacity for X billion dollars of assets. And so it's like, well, obviously, that crowds out a newcomer to the space that may very well have a native understanding. And it's just that the assets haven't shifted so dramatically until the advent of digital assets and, of course, Bitcoin specifically.
Yeah, and I think one thing that, as I've moved into the new role and learned more about kind of how TradFi operates, it seems in a lot of the ways lawyers are kind of the developers of TradFi, right? Where they're kind of the ones that are handling kind of the programmability, so to speak, and doing a lot of the low-level work. But what are some of the features you think that, as we move towards this next generation of allocators, that they will be demanding when that understanding comes through? You talked a little bit about multisig and time locks. I think projecting forward, kind of what are some of the things that will be an allocator of the future, where it's like, hey, if you don't have this, this is table stakes. I think we can start with you, Sam, just kind of, and go back down the line.
Yeah, if I can be insufferable for a second, I do love this concept. And I'm just reminded of Andreas Antonopoulos', and I don't know if it was his concept, but infrastructure inversion, where the new technology does what the old technology does, but it does it in a much better way. And so when cars were invented, there wasn't infrastructure for cars. It was simply a better version of a horse. But the world that was opened up because of that was unimaginable previously, though it does the thing that the old thing did. And so later on, there's apparently a flip or an inversion where the old tech can ride on the rails of the new tech trivially. The inverse isn't as easy. So, we can make a Bitcoin transaction take 3 to 5 days, but we don't need to. It doesn't need to do that. Just like when we had voice over internet, we artificially introduced this like staticky noise when no one was speaking on the phone because people thought the call dropped, though that the technology functioned so efficiently it didn't need that. So I think in Bitcoin, the thing that we're focused on, a lot of this stuff like you were saying, Ian, is, I think, pretty, I mean, the sort of implementation I don't think is novel. For example, things like escrow, that is a sort of, old financial tool, and we can certainly use and adopt that in Bitcoin. What we're trying to see, what we're trying to experiment with is this concept of proof of serviceability. So the self-custody assets you have should be incorporated into your financial profile, and because it's asymmetric in that you hold it yourself, there's very easy things you can do, like prove intermittently that you still have control over the keys, and that itself can become a function of the agreement. So to Andrew's point about programming money, those are kind of the basic easy things that Bitcoin natively offers that traditional assets just don't.
Yeah, I would add to that, which is something that people forget, but you can sign a Bitcoin address. Like, that's one of the features of a Bitcoin address. So if you're asking for a proof of reserve, well, that sounds good on paper, but why not prove that you actually control it? Why don't you prove that you have access to that by just signing a message? Things like that. I mean, there's all kinds of strategies that you can take to say, what's my goal? What am I trying to do? And just to remind yourself what it is that you're doing due diligence on. Pension funds, you used to, work so hard to pick the right manager because so much trust was put in the manager. But then you would have to constantly reevaluate. Otherwise, you do diligence on the front end of a deal, you do all this work, and then the deal's over and you kind of forget about it. And it's like, well, but there should be ongoing diligence as well. And that's one of the nice things about Bitcoin is because of the nature of the asset and the programmability, there are ways to kind of continue to check and do things that in the past became difficult. Like a lot of time, if you're doing deal work or you're making an initial allocation, as soon as it was over, like everyone just wanted to drink and forget about it. Like even whether it was high five or just like go crawl in a cave and disappear for a while. Now you have to remind yourself that it's not just set it and forget it. Like, what can you do to have constant vision into the challenges? And that's one of the drawbacks, I think, of Bitcoin. People talk about it can be traded 24/7. Well, that also means it can be stolen 24/7 or it can be defrauded 24/7. So you have to just remind yourself that some of the best features of Bitcoin are also some of the new risks that they've always been there, but you have to just remind yourself of it to kind of keep doing your due diligence even after your, quote, due diligence is over as you move forward through time.
I think that's fantastic, and I do think that, coming back to the present time, understanding that maybe some of these custodians are not necessarily using the most advanced features of Bitcoin. We work with what we have. So when you look at custodians today, what are some of the priority things that you're using to measure kind of counterparty risk and evaluate how good they are? That's not just, well, they're BlackRock.
Well, the evaluation lives within the regulatory environment that a company exists in. And so if you're talking about an institutional asset manager that is operating in the United Arab Emirates, then they live within a different regulatory regime than someone that's a registered investment advisor in the United States. And for the time being, in the United States, there's a lot of emphasis around this idea of qualified custody and qualified custodian. And as of yet, although there are developments that hopefully can advance to fruition in the relatively near future, there are not multi-institutional, multi-sig setups that are qualified as qualified custodians. And so, you revert back when you're talking about managing client funds to, yes, you can get to multi-sig, but you still are relying upon a single institution. And of course, you would evaluate it as well on the basis of fees and on the basis of the procedures that they have in place to verify the authenticity of a trading request or a withdrawal or something like that. But, there's what Bitcoin can do, and then there the structures that different types of regulated businesses have to operate within. And for a pension or someone to say, oh, well, and they're going to revert to what the regulator says. If the regulator says best practice is for an RIA to use a qualified custodian, a pension's not going to independently say, we're going to try to find someone that's not going to use a qualified custodian because we really want multi-institution, multi-sig now. It's not realistic within the context of CYA.
I think it really goes down to allocator needs. I mean, there's a couple sort of basic criteria that I usually recommend, but I really think reputation goes a long way. I think it's a small space, and working with with companies and with individuals that do have that reputational sort of capital, I think is really important here, especially given sort of the fraudulent risk that is sort of also native because it's a new asset and because of its sort of Wild West nature. The ability for omnibus to segregated wallets, how they think about that, and that also depends on what your needs are as an allocator. And I would throw in proof of reserves in there as well. Some type of transparency over the assets that you can, to the best of your ability or the best of the custodian's ability, independently be able to verify in some capacity. I think those are three easy things to look at.
I think those are all good points. I mean, again, getting back to features of Bitcoin and how do you take old-time principles and try to adjust to new environments, transparency is the best one. I mean, you have literally an open ledger, and so you don't want to outthink yourself and get too cute by half and make it too difficult. There are some very crude instruments that work right now with transparency, multi-sig, and other things that as you navigate through different jurisdictions, I mean, that you also have other protections. And so you don't have to forget that, you know, if somebody takes advantage of you, you still have access to the common law legal system in the U.S., or you can have the ability to check a license to make sure that they are regulated as they say they are. But you also have transparency, and you can verify things on chain, and you can do other things to know if I'm trusting somebody with my asset or if I'm sending them an asset to go and do something special with it, what line of sight do I continue to have? Because every step along the way, there's the risk that you lose transparency. And so what features can they do? If they're going to operate your Bitcoin for you or do something exotic with it, well, what is it? How is it being regulated? If it's a derivative, you have access to those markets. Or if it's just you're going to invest and you hope they become a SATS flow positive company and they do it well or do it better than the next guy, or if it's a treasury company where they're doing more creative things, there is line of sight into each of those. But there also starts to be barriers to be able to see through it. So you have to just remind yourself what's the purpose and get back to what other tools do I have beyond just the technology to get visibility so I don't leave myself shrugging my shoulders because I'm at a board meeting or something and I can't explain to my colleagues what's going on because I don't understand the technology. These really, you know, that's not usually the obstacle. The obstacle is you just trusted too much or trusted blindly, and you shouldn't have to. There are ways that whoever is taking the Bitcoin can give you line of sight into how it's being used, what's being done with it, and then those various structures in place.
Yeah, I mean, just building on it, I think that the most important thing to realize for an institutional allocator is that the tools of Bitcoin are better. They're better as they are. And because Bitcoiners are skeptical, demanding, technologically oriented, you know, we make a big deal about the improvements that we foresee in the future and the vulnerabilities that we can imagine right now. But as it sits here right now today, they're better than other alternatives. I mean, I'm familiar, if you buy real estate, for example, or if you own real estate in the city of Philadelphia and you do a transaction, like a few weeks later, you get a letter in the mail from the Department of Records that says, this is to let you know that there's been a change recorded on your deed. And if you're not familiar with that change, please contact us because there's been a high degree of real estate fraud. Now, it's not like you go to a real estate conference and people sit there and they say, well, this is a reason not to invest in real estate. I mean, they just, you know, endemic. And there again, with the whole quantum discussion, you don't go to, I mean, to the extent that quantum computing is a serious threat to the encryption security protocol that applies to Bitcoin, it's definitely also a serious threat to your bank account, to your brokerage account, to, you know,
Everything digital, that's
right?
secured,
Everything
yeah.
digital. And it's not like you go to, you know, a Morgan Stanley equities conference where they're talking about the PE of healthcare companies, and then there's a little side conversation about, well, is quantum going to threaten your brokerage statement? And should we even invest in stocks? And so when you put it into this context, I think that we really ought to be more forward, and we should try to use vocabulary that is somehow analogous to what exists today in conventional investing markets.
I agree with that wholeheartedly. And one aspect that I want to bring up as well that you've touched on is in the U.S., like this conversation has been very focused on the U.S., we do have the best and most liquid capital markets, you know, in the world. But one of the things about Bitcoin is Bitcoin works the same no matter where you are around the world. And I do think it's really important to talk a little bit about how having the same quality tools that are better than what we have in the U.S. today, having those same tools available for, allocating internationally is important, right? And I think we can start, Ian, with you, because obviously, with Ocean, you guys don't custody any funds of your customers, which is different from many mining pools. I don't know if you have data or want to share about kind of international partners, but it allows you to have the same quality business relationship with a customer in Paraguay, right, as it does with a customer in the U.S. So I think just kind of touch on maybe some of the Bitcoin native qualities that, to your point, allow you to continually verify and continually ensure that you have an ongoing business relationship without kind of the controls that you have here in the U.S.
Yeah, so when we made the decision to form in the U.S. and not take custody of clients' Bitcoin, we made sure that as a software company, we arranged for the payments to go directly from the Bitcoin network to the customer. Mm-hmm. And that allowed us to not be a money transmitter and allowed us to not engage in the same type of regulatory scheme that, a custodial FPPS pool does. That was intentional. But it also makes it permissionless. So, we have to find other ways to verify that this person needs tech support. Well, what's your Bitcoin address? Who are you? We don't know who you are. It creates language barriers. It creates other challenges. But, I think you're seeing what used to be the only game in town being the U.S. for capital markets or other things. Now you're seeing a flattening of that. And that's going to create its own risk profiles. And it's like, I don't want to go back to 1492 and say Venetian and Italian traders with ships moving. Those kind of old problems are new again. And so you have to just remind yourself that, when you start to flatten these things and create opportunities either for investment from abroad or investing in overseas things to say, all right, what protections do I have beyond just the technology? And it just, again, it creates enormous challenges sometimes, but on the other hand, it creates great opportunities too. And so you just have to, as you pivot through the new technology and try to understand it and try to be on the edge of it, not to outthink yourself and get back to basics and understand who is the counterparty, what's really going on. And that's one thing we hide behind, in a sense, is that because we can point to chain transactions, well, you can trust our dashboard, but you don't have to trust our dashboard. You can actually go on chain and independently verify. So that adds a layer of transparency for us. And I think other companies in this space would be wise to take a similar approach, adding transparency where possible. That's a feature of Bitcoin. It's one of the, in my mind, it's one of the best features of it. And to leverage those good features in plain spoken, regular ways to minimize or mitigate your risk.
It's so refreshing having someone else talk about transparency and not be the only person that's banging on that drum. To continue being a little bit insufferable, just like a mental model that I think might be helpful is, I've seen Bitcoin for quite some time, and I think we're still going to be here for a bit. I see Bitcoin as a sort of a country in the global south. It's like a third world country with respect to property rights and what we're able to do. The reason why countries in the global south are poor is not because of IQ or cultural idiosyncrasies. It's because they don't have good property rights or legal frameworks that do anything with the property rights that they have or don't have. In Bitcoin, our property rights are native. We don't have that monopoly on violence that is required for most jurisdictions. We are our own jurisdiction. And I love thinking about it like that, because the opportunities really are kind of limitless in that sense. And also the growth pattern is really, really optimistic. So we're sort of in those beginning phases, but yeah, we're kind of like a digital third world country.
I would say first world country, but point taken. And I do think, not to get political, but there's been the experiment of trying to kind of export democracy globally. I think a lot of what Bitcoin does is it exports property rights globally, and it gives anybody that can hold a private key and hold their own Bitcoin. You now have the best property rights that have ever been invented. Nobody can take or debase your funds or stop you from spending them without your permission, and that's super, super powerful. And I think, Andrew, real estate is a little bit of a different animal because you can't get around kind of the local regulation because you're dealing with a physical thing. But when you think about, investing opportunities internationally that aren't necessarily in the U.S. context, there certainly are aspects of the Bitcoin protocol, to your point about it being better than what we have today, that would give you maybe the same level or an improved level of trust in an international opportunity, even if you don't have the typical U.S.-based checking licenses, legal framework, et cetera, right? There are aspects of Bitcoin that would give you a similar level of confidence in pursuing those opportunities.
Ryan, I will share some very preliminary conversations that I was having recently with some individuals around the COP30, which is happening this year in Brazil and is focusing on the rainforests. And over the summer, I received some outreach from professors from different universities and something called the Public Defender's Office, which is an organization. I mean, frankly, I don't really know all that much about this landscape that I'm sharing with you. I'm just giving you a little insight. But apparently, the Public Defender's Office is the government body in Brazil, anyway, that's responsible for enforcing a lot of the laws in the rainforest area. Forest. I'm sure you all have heard of it being referred to as like the lung of the earth, and it's such an important place for carbon sequestration, etc. But the problem, as I've come to learn about it, is that it's so vast, and although it is this global commons, the ability to police it is really not feasible. And large tracts of land cannot be efficiently law enforced. And what happens is that you have gangs or criminals or just people that are claiming ownership over these lands that otherwise might properly belong to indigenous people. They just show up and they're like, look, this is our land now. And there's no way to actually stop them from doing it because the cost of effective policing is way too high. And so they clear cut the lands, they get revenue from the timber, and it's better for them, but it's worse for the earth. And so now you have commitments from other countries that are giving like, oh, I'm going to give, France is going to do $30 million to, this program, and Germany, et cetera. But then I've learned that a lot of that money dissipates through corruption. The question that the brainstorming session, unrelated to Bitcoin, but the brainstorming session was, how can we address this? And to me, I started thinking about Bitcoin. And I said, well, what if we shift the incentive scheme? Instead of trying to create a program that, promote, or maybe in addition to creating a program that creates economic development in that area and therefore has more jobs for local people so they have the resources to protect that land, we take like $100 million, for example, and establish an Amazon Bitcoin trust fund. And then we say, here are the KPIs that we're seeking to solve for in this geographic area. And if these KPIs can be achieved, then the people who can verifiably show that they contributed to the achievement of them, they get to share in some of the Bitcoin or some of the Bitcoin upside over time. And so you shift the focus away from the intrinsic property value of the land in the Amazon, and you shift it toward this thing that's actually much easier to protect, which is transparent, verifiable, divisible, fungible, all of the things that Bitcoin is. And through these new kinds of incentive schemes, I think that we're really well positioned to imagine, frankly, this type of application across a huge number of different social challenges and challenges with the commons.
Yeah, I was talking with a startup 6 months ago that was kind of talking about how with all of the cuts to U.S. aid and stuff, it was like kind of 2008 crisis for the international aid community, and so they were kind of trying to rebuild and reimagine what was possible without all of these intermediaries who, frankly, there was, to your point, like a lot of leakage of the aid as even just parties are taking cuts, getting closer and closer to the people who need the aid. But with Bitcoin, the whole point is peer-to-peer. You don't need third parties. You don't need trusted third parties. You can just go direct to the source and leverage kind of Bitcoin's unique trustless capabilities and verifiability to improve the solution for everybody. So I think with that, we'll take some questions.